Have you ever just stared at a trade and wondered, what on earth was I thinking? Well, today we are leaving all that gut feeling guesswork behind. We're going to build a super clear, objective framework that tells you the market trend, pinpoints your entry, and locks in your risk management. And it's all based on rules, not feelings. All right, let's dive in.
So let me ask you something, and be honest. When you click that buy or sell button, what's really behind that decision? Is it a repeatable, tested rule, or is it kind of just a mix of hope, a little bit of fear, and some good old-fashioned guesswork? This is the core battle every single trader faces, the fight between a subjective feeling and an objective system.
And believe me, the difference between the two is night and day. On one side, you've got the emotional chaos of subjective trading. It's like this stormy cloud of guesswork that just leads to stress and really inconsistent results. But on the other side, you have the beautiful clarity of objective trading. It's a clear target built on a checklist of rules and a repeatable process you can actually follow with confidence, whether you win or lose. This right here, this is pretty much the foundation for everything we're building today. Objectivity is what separates a professional, systematic approach from just, well, gambling. It's absolutely the key to surviving and actually thriving in the markets for the long haul. So how do we get there? Here's the game plan. We're going to break it all down into 4 clear, actionable steps. First, we'll nail down the primary trend with one simple, unbreakable rule. Then we'll get super specific on our entry location and signal. After that, we'll cover how to manage risk objectively. And finally, we'll put it all together into a complete trading framework you can use. Let's start with the most important step of all, knowing which way the market is actually trying to go. Because without a clear, objective rule for the trend, every other decision you make is basically built on a shaky foundation. An uptrend, it doesn't move in a perfectly straight line, it moves in waves. The first part of that wave is what we call an impulsive move. That's that powerful surge that just smashes through a previous high point. This is the market showing its cards, really signaling its strength and its intention to keep pushing higher. But here's the thing about markets. They never move in a straight line for long. After a really strong, impulsive move, the price naturally pulls back. Now, this isn't a sign of weakness. It's just the market taking a quick breather, kind of gathering energy for the next potential push. This whole rhythm of impulse and pullback, it's like the heartbeat of a trend. And here it is. This is the big one, our non-negotiable, crystal clear rule for an uptrend. As long as the current pullback, the little dip we're in right now, stays above the low of the last pullback, we are officially in an uptrend. That's it. This one rule cuts through all the noise. And what does it mean for you? It means our bias is set. We are only looking for reasons to buy, period. Okay, so we've confirmed the trend. We know we want to be a buyer. But where exactly do we buy? And maybe more importantly, when? Finding that precise entry point is next. And we're going to break it down into 2 key parts, finding the right location and then waiting for the right signal. The highest probability entry location is almost always at a previous level of structure. I want you to think of it like a ceiling suddenly becoming a floor. When the price breaks through a resistance level, that old ceiling, it very often becomes the new support level on the pullback. This break and retest zone is the sweet spot. It's where we want to be waiting. So we found our perfect spot, we're waiting patiently. But just because the price gets there doesn't mean we automatically jump in with our money. No way. We need a specific objective signal that tells us, hey, buyers are stepping in right now and taking control. So what does that signal actually look like? Well, for our signal, we're going to use a really specific pattern called the 38.2 candle. Now, you can forget about trying to memorize dozens of complicated candle names. This one pattern tells a very clear story. Sellers tried to push the price down, which created that long tail on the bottom. But the buyers fought back hard, and they closed the candle way up near its high. It's literally a picture of powerful buying pressure. And here's the best part. This is how we make it totally objective. You just take a Fibonacci tool, and you draw it from the absolute low of the candle to the absolute high. If the entire body of that candle is sitting above the 38.2% level, it qualifies. It's a valid entry signal. There's no guessing, well, it kind of looks good. It either meets the rule or it doesn't. Simple. So, trend, check. Location, check. Entry signal, check. We've got almost everything. The final piece of this whole puzzle is protecting our capital. I mean, a great entry means absolutely nothing if you don't manage your risk properly. And just like everything else we've talked about, our risk management has to be objective. To do this, we're going to use an indicator called the average true range, or ATR. All the ATR does is tell us the average amount a market has moved over, say, the last 14 candles. So essentially, it's measuring the market's natural wiggle room. And using this helps us avoid setting our stop loss so tight that we get knocked out of a perfectly good trade just by normal market noise. For instance, let's say on this chart, the ATR value is 66 pips. Now, pips are just those tiny units of price change. So this number is telling us that, on average, the price has been bouncing around by 66 pips per candle. Now, think about it. Trying to use a tiny 20 pip stop loss here would just be ignoring reality, right? You'd almost certainly get stopped out by the market just doing its normal thing.
So here's our simple data-driven formula. We find the low of our 38.2 entry candle, and then we just subtract the current ATR value from it. So in our example, that would be the candle's low minus those 66 pips. That point right there. That becomes our objective stop loss. It's smart because it respects the market's volatility, and it gives our trade the room it actually needs to breathe. And just like that, we've now built all the individual pieces of a professional trading plan. So let's put this whole puzzle together into a simple, really powerful framework that you can use every single time you sit down at the charts.
And here it is, your complete 4-step objective checklist. Before you even think about putting on a trade, you just run through these 4 questions. Number 1, is the trend rule valid? 2, is the price at a key location? 3, is our entry signal actually there? And 4, is our risk managed with the ATR? Look, if you can't tick every single one of these boxes with a yes, there is no trade. You just walk away. It is that simple. This is how you go from guessing to trading with a clear mechanical edge.
And that brings us to the end. You know, this journey from subjective to objective trading, it doesn't happen overnight, but it does start with one single step. So I'll leave you with this question. What's one rule? It could be for trend, for entry, or for risk. What's one rule that you can make completely objective in your own trading, starting right now?